There are several types of charts a trader can use for analysis. We'll show you the most popular ones, and to make things simpler, all the examples will use the same trading session. A line chart has a single line connecting all the closing prices. It doesn't offer much detail, but a line chart is good for observing long-term trends and picking out patterns like head and shoulders and triangles. A bar chart shows the closing prices, the opening prices, and the highs and lows of a security. Candlestick charts show the same information as bar charts, except for each candlestick having an enlarged region between the opening and the closing prices. It's called the body of a candlestick, and it makes it easier to spot bar patterns. A point and figure chart has a series of X's and O's. Each X represents an increase in the price, and O shows a decline. Whenever the market reverses, a new column is drawn. That's why a trader never sees X and O in the same column. This chart is mostly used for long-term trends, like the line chart. In a 3-line break chart, a new line in the same direction is drawn when the closing price is beyond the closing price of the previous line. A reverse occurs when the closing price is beyond not one, but the last 3 lines in the opposite direction. This type of chart works well for the trend line and the support and resistance analysis. The Renko chart comes from the Japanese word for brick. Each new brick appears when the price moves more than the brick size away from the previous brick. Since a Renko chart doesn't display the exact price action, it isn't fit for the bar pattern analysis. But since it strips away all the noise in the form of smaller price movements, it's excellent for observing trends. A AKAGI chart line changes direction when the price reaches a predefined reversal amount, which is usually set at 4%. The thickness of the line increases when the price goes beyond the previous vertical line. Often thin and thick lines are replaced with lines of different colors.